Hello, and welcome to the Xactly Virtual SPM Summit. I'm Jason Rothbaum, and I will be discussing the compensation trends that our practice has seen in the age of unprecedented. I'm the practice lead in Xactly Strategic Services, and I've been designing sales compensation plans for about 20 years now. I have a background in consulting. I've been with the Alexander Group and Deloitte Consulting. I also ran the sales operations divisions at Charter Communications, Deco Staffing, Sonic Healthcare, and Viridian Energy. Today, we'll be looking at how companies have reacted to the uncertainty created by COVID and how they're getting ready for growth through their sales incentive plans. But before we jump in to the plan changes, I just wanted to go very briefly through our practice. We're a small group of industry experts. None of us have fewer than 15 years of experience. And we work with companies quickly on best practice design solutions that keep implementation costs low. We can leverage a large database of Xactly data and provide industry pay and production comparisons. Note that production is a key differentiator here because few, if any, other surveys have that, as well as having a deep well of technology experts so that our solution designs can be implemented very quickly. And so with that, let's jump right in. You've heard it so many times in the past year. What does unprecedented really mean? This has been such a huge hit to our economy, but it was also followed by the quickest rebound ever. Certain areas of the economy have been booming while there's been high unemployment. The way that we work has changed as we've had some of the highest growth in productivity ever. And many businesses are not able to adapt while others have been growing. And if you read about what economists say, there's no agreement there. Some economists say that we're approaching a huge recession. Others are saying that we are through the worst of it now. And I guess that the consensus is that it'll affect different industries differently. But when you look at all of these factors together, it's just uncertainty. It's another period of economic uncertainty. And that has a lot of commonality to what we've seen in the past in things like the Great Recession and things like the tech bubble burst. When there's times of economic uncertainty, companies will have difficult choices. And depending on the choice that they have, there's certain off-the-shelf compensation solutions that they'll enact. So when we look at that, in the past year, the companies that our practice has worked with, there have been nuances to this, but they generally fall into two camps. The first camp is those that chose to weather the storm. And I would say that 2/3 of the companies that we dealt with chose to go with that. And that means that they've largely tried retaining the sales team that they've constructed. They've tried to minimize the amount of bleeding that the reps have been experiencing, and they've really tried to just weather the storm. Then you have the other side of the coin, which are those companies that chose to resize the sales engine, and that is approximately 33%. And when you look at those companies, they're the less friendly avenue, if you will. They're the ones that reduce the number of sellers. They reallocate sales responsibilities. And, when you look at those, they tend to be looked on poorly. But I would say that between strategy 1 and strategy 2, they're both very valid strategies, and they're really company specific as to what's best for your situation. When we look at the strategy 1, you tend to build company loyalty, but that strategy, when you look at it in the long term, tends to keep the low to mid performers. And whereas you look at strategy 2, it's less expensive, obviously. You're reducing the number of sellers, and you tend to keep your higher achievers with that method, and you tend to shed your lower and mid. If you look at strategy 1, it really is meant to retain your sales force so that you don't have to ramp up quickly, that you're just ready to flip on the switch and start selling. Strategy 2 requires another rapid ramp up. So that's going to be for those industries that can turn it around quickly, hire people fairly quickly, and are willing to live with the disruption. And as I said, I don't take a position on which one is better, but I will say that the timing does matter. If you are going to follow strategy 2, it was best to have done it probably a while ago. Doing it late in the game is probably not, it doesn't have as high an ROI as strategy 1 at this point. So what I'd like to do is just go into some of the details of what it means from a compensation perspective if you choose to weather the storm. And what are some of the common changes, or the off-the-shelf changes that you would see for those types of companies. And they make adjustments to the sales compensation plans. And I will say that when they do that, they're trying to keep the reps in the game, trying to relax the reallocation of pay and just get money to people. Whenever you try to relax what is one of the basic tenets of sales compensation, which is reallocation of pay from low to high performer, you tend to relax best practices. So once again, these are common plan adjustments. And I will say that most of them are not best practice, but this is what companies will do. They'll remove the kinks below 100%. What does that mean? Well, if you look at the payout curve, the commission rate, if you will, between 0 and 100%, companies will try to increase that as performance increases. During a downturn, they don't want to pay people low for low performance. They want to pay people anything for any sale and keep them in the game. So they will, instead of having, let's say, 3% up to 80% and 4% up to 100%, they'll just pay a flat 3.5%. They'll remove all of the kinks in the commission rate up to 100%. By doing that, automatically, you're not going to have a minimum level of performance. They want to pay people for any sale and get money in their pockets to keep them in the game and keep the sales force intact. So they're not going to have minimum performance levels before you get paid, these thresholds. Companies will often add kickers. We'll pay you even more if you can get a strategic product or a strategic customer. So they're trying to pay people what the compensation plan would normally pay, but I guess more for strategic types of sales. Another thing companies will do is they'll stop these crediting splits. What is a crediting split? If 2 people are involved or 3 people are involved in a sale, they'll cut up the sale and you'll get 30%, you'll get 30%, you'll get 40%, something like that. In a downturn, companies will actually remove that and say, you all get 100%. We're going to pay more than what we've budgeted for compensation just because you're doing what we need you to do, which is to sell. We're going to get more money to the reps who are doing something. A bit of a more extreme option is to provide a guarantee, which is saying that we're going to pay at target for a period of time because we expect that the downturn is going to be short-lived. So we're just going to pay you at your target pay for a quarter or 2. Not many companies did that this time. A lot of companies will shift weight to non-financial measures, number of meetings held. And these are absolutely bad practices under normal situation. They're not best practices. But companies have done this quite a bit in the past year because they consider it priming the pump. You're doing what we're asking you to do as a rep. So we're just going to get you money for doing that, even though we know it's not going to generate as many sales. Companies, a good practice that I've recommended to a lot of companies is to enact shorter measurement periods. Instead of paying annually on a measure, pay quarterly. Why? Because reps have the opportunity to enter over quota pay, those accelerated over quota payments, more often. Instead of reserving that high performance pay until the end of the year, you have 4 chances under quarterly. And another way that companies have been weathering the storm is by adding more payment opportunities, these incentive measures that have absolutely no weight to them. So a company will add a bundling measure into the plan. Even though you don't have to do it in order to earn your target pay, we'll just pay you more for doing it. I'll say that out of the 2/3 of the companies that have been doing this, that I would say that most of them have added these non-financial measures, and they've shortened the measurement periods. Like I said, these generally don't go with best practice. Another example of weathering the storm is priming the pump. And these are extremely popular. And I will say that usually these do align with best practices. These are what I would normally recommend in a downturn, which are offering things like SPIFs, milestone payments that significantly increase the probability of a sale. Softening President's Club qualifications, because we all know it's a buzzkill when President's Club comes around and no one's going. Offering mentoring pay. So you have more tenured reps, you want to funnel money to them, offer them money for being a mentor to someone. Marketing support bonuses are incredibly popular. And marketing wants to enact a new initiative to get the word out. And they'll actually offer supplemental pay to the reps to assist them. So it doesn't fall necessarily within the sales wheelhouse, but it is a high value ROI to the company in the form of marketing. Product development support bonuses, incredible use of money, which is to launch new products, to launch special bundlings of products, new strategic initiatives and test markets, and offer reps in those markets opportunities to earn supplemental pay for supporting that. Product conversions. So we have let's say an on-prem product, we want to convert customers to a SaaS product. Even though it's net neutral to the company as far as revenue, we got to do it. And it offers a longer term value to the company to be on the newer product. So we're going to offer a product conversion bonus to the reps. And finally, training bonuses. This one doesn't have as clear a link to ROI, because what will often happen is that people who are highly trained will leave the company at the end of the level of the period of uncertainty. But if you put some sort of conditions upon it, that training bonuses will link to higher pay so long as you stay employed with the company at a later period, they work great. I put this as the nuclear option. A lot of companies did this, and I would say that it's all right to do quota relief so long as it is done in a certain way. But just lowering the quotas is akin to just giving everyone a pay raise without any form of return to the company. And if you are going to do a period of quota relief, I would highly recommend you do partial relief. You built this sales engine that was meant to produce, in this example, $100 million, and you budgeted $10 million to do it. So you had a compensation cost of sale at 10%. If you did full quota relief, which is all the way to the right, okay, we forecast the market at $80 million now. We're going to still pay them that same $10 million. It's an automatic cost increase to the company. So if we forecast $80 million, I would do a bit of quota relief, partial quota relief, and lower the pay. There's no reason why the company should carry the full burden of the economic downturn, and the reps should suffer, well, not suffer, should carry none of it. It's an at-risk plan. And I often say this, that, in an up market, we're capitalists, but in a down market, we're all communists. We share the pain. In an up market, if times are unexpectedly good, are you going to raise quotas? No. If times are unexpectedly bad, why should you be expected to lower quotas the full amount? The resizing of the sales team is the other extreme option, but it does make sense in certain industries. Financial services, hospitality, they can ramp up incredibly quickly. And if you look at this, this example is a straightforward one. There are obviously nuances to it, but we had 2, 4, 6 reps, each with a $1 million quota. All right, we no longer expect to produce 6 million. The engine that we built to produce 6 million can't do it anymore. We can only produce 4.8 million. So why should we have that Ferrari engine? We have to resize the engine to produce 4.8 million. Notice though, everyone got a raise who was retained. We've increased their quotas. We passed the plum accounts, the plum leads to the ones that have stayed. Their pay levels went up and their quotas went up marginally. So we still retained a compensation cost of sale of 10%, but people got raises. A very viable option. It is more disruptive, but we have seen productivity go up during the pandemic, and I would guess that this is one of the reasons why. The other one that's very popular, and you've probably gone through this in the past as a company, is to reduce the number of sales support functions, the overlays. And I won't go into too much detail. I want to save time for other things, but we had a specialist and an engineer supporting each sales rep in this example. Right? We consolidated it. We reorged. We reserved one specialist for 2 sales reps, 1 sales engineer for 2 sales reps. And you can see that there's compensation plan changes that have to go along with that because it's a fundamentally different job role now that we're expecting the sales rep to have. Right? They're now expected to be generalists rather than a quarterback of a team. So as interesting as that is, most companies now are keeping an eye towards ramping up and growing. So how do we grow during at the tail end of a pandemic or as an uncertain period? Surprise, most of it is just unraveling what you did during the pandemic. Shift incentive payments for more growth. A lot of companies during the pandemic shifted away from new sales measures towards retention measures. Well, flip it around for the growth phase. Shift money from retaining business towards paying more for growth. Simple change of compensation incentive weights. And we had spoken about it before. Companies had shortened the measurement period. Extend the measurement period. We're not as concerned anymore about the difficulty in backloading pay because we're expecting more sales. So we can pay you annually, and we can kink the payout curve as well. So pay can be backloaded. And that's exactly what we're talking about here at the top of the next slide. We can pay less up to 50% of your quota. Okay, we're going to reallocate pay from lower performers to higher performers. We're unraveling a lot of the things that we did. So this is simply saying that between 0 and 50%, you're getting a low rate. Between 50 and 80, your rate goes up, and between 80 and 100, you get even higher. Okay, we're intentionally backloading pay, which during the pandemic, or during right now, actually, it's probably very difficult to do. But as we gear up towards growth, this is one of the plan changes that's going to have the most impact. Another thing that you can consider, which is always a good practice, so long as you understand the risk level in a company, is to trigger payments as close to the sale as is feasible. What does that mean? During the pandemic, it might have been very difficult to pay on contract signing because you didn't know whether a company was going to pay you, whether the payment terms would have to be renegotiated, whether your client would go out of business. Well, now there's a lot less concern. We could take that risk as a company, a little bit more risk, and pay more towards the contract signing. That is an aggressive growth mentality. We're turning our reps away from being debt collectors into being acquisition sellers. One of the things I wanted to go through quickly is a sample plan that I've been asked to create, as it were, or have been driven to create over the past few weeks as companies are gearing towards growth. And this is called a bonus flip to commission plan. It is looking at companies as a way of growing equally. One of the things that usually happens during your growth phase is that growth doesn't occur equally across all areas. Some territories will grow more, other territories will grow slower, but we basically want to reward for growth while paying for maintenance, a fixed amount. So companies will change the job roles to a generalist during the pandemic, and they now have a blended hunter-farmer role rather than a hunter and a farmer. Okay, well, we're going to pay a set amount If you're in North Dakota or New York City, you get, as an example, $50,000 for hitting your quota, regardless which territory you're in. But over quota, we're going to pay you a fixed percent as well. Now, New York may have a $10 million quota. North Dakota may have a $1 million quota. We don't have to worry about pay disparity or differences in growth rate. Let's say you're in the oil and gas industry. North Dakota is a booming territory. They might have a higher quota than New York, just as throwing it out there. So at a certain phase, a bonus flip to commission pays target incentive at quota, but any growth above that quota pays equally. So your quota can be different. And you don't have to worry about large territory, small territory. All territories are going to be paid at a fixed amount. And then over that, we're going to flip it to a commission plan. So I did want to reserve some time for questions. I'd like to thank you for joining me for the session, the virtual session. Normally I'd be in front of a room and, working the crowd a little bit, but I thank you for joining, and I'm open to questions now. Thank you.